Good morning, everyone, and welcome to our Spring Economic Forum, where we discuss our UK and global economic outlooks. And I have to say, it's a beautiful spring day out there. So I hope that you're all watching us online, outside in your garden, enjoying the sunshine. As per usual, we're going to have three presentations. Patricia Sanchez Juanino is going to tell us about the outlook for the global economy. Fergus Jimenez England is going to tell us about the outlook for the UK economy. And then Adrian Pabst is going to tell us about the outlook for UK regions and households. As always, if you have questions for any of the presenters, please could you put them into the chat? And then when everybody has finished presenting, we will go through the questions. We'll ask you to unmute yourself and then ask your question. But if you put them in the chat, then we know who to go to for questions. I should say, putting on events like this, we can only do it, really, and these are with your support. So when we get to the end of this, if you feel you've learned something and you feel the experience has been good, then do consider joining up as an individual NISA member. It only costs £150, and you can find the link on the website. You can also find the link to the UK Economic Outlook itself, so you can go away and read it once you've seen the presentations. Okay, on that note, I'm going to hand straight over to Patricia, who's going to tell us about the outlook for the global economy.
Thank you very much, Stephen. Good morning, everyone, and thanks for joining us today this morning. As said in the introduction by Stephen, I'm just going to talk about the latest forecast of our global economic outlook. This forecast is the result of the hard work of all the people that you can see named in there in the slide. May I thank all of them. And for the forecast, we use our global macroeconomic model, NIGEM. NIGEM, for those who doesn't know, is a global macroeconomic framework and is employed worldwide by many of our subscribers for purposes such as economic forecasting, scenario analysis, and stress testing. So this presentation is an example of some of these uses. And if you want to become a subscriber and being able to access to the software or the data that is being shown here, please feel free to contact us through the chat or by email, and we will be more than happy to help you about that. So say that, let's talk about what we currently think about the global economy. So here you see the key messages of our global outlook. And this outlook is being dominated by President Trump's tariffs announced in his Liberation Day, and all the later revisions and postponements of some of these initial tariffs. So we think both tariffs and all the uncertainty posed by these constant policy changes will weigh on the global economy. And as a result, we cut our global growth forecast 0.3 percentage points, both in 2025 and 2026. We have done a scenario analysis, particularly on tariffs, and it shows that the US is one of the most affected countries from their own tariffs, together with Mexico, Canada, and China. Partly due to the tariffs, we expect that inflation will generally rise in the OECD countries, but we don't expect this to slow central banks' rates cutting cycles. So we will expect ECB and Fed to continue cutting rates. Despite the high public debt levels, we expect fiscal policy to remain mostly supportive and expansionary in major economies. Let me run through some of the illustration of this. The first thing I wanted to talk about is the context. The context that we have, in which we have created this forecast. As you may already know, on the 2nd of April, President Trump announced what he called reciprocal tariffs, ranging tariffs from 10% to 54% on all economies. This caused significant disruptions in financial markets, and in particular, index, as you can see there in the right-hand side, you see the VIX index, the Chicago Board Option Exchange Volatility Index, or the S&P 500 Volatility Index. We saw on those indexes the third highest daily figure after the COVID-19 pandemic and the financial crisis. Partly because of this reaction of financial market and indexes, President Trump announced the 90-day pause for some of these tariffs, while keeping a 10% tariffs against all countries. As of 9 of April, this tariff increased the average effective tariff rate to around 20%. You can see there in the chart at the left, which is the highest level in over a century. In addition to all this tariff war, President Trump has also started to implement some other economic policies, including migration policies or taxes, which leaves us in a high uncertain economic environment. In terms of the global growth, or our global forecast growth, and given all this context, we expect that the global economy to grow by 2.9% this year and 2.8% next year. As I said at the beginning, this is approximately 0.3 percentage point downward revision in both of the years compared to our winter forecast, as you can see there in the red bar charts. Downside revision in the global growth is mostly due to slower growth prospects in advanced economies, which we have revised down from 1.8 to 1.4. In terms of the emerging markets, we are also revised down our forecast from 4% to 3.9 this year. Furthermore, as you can see in the fund chart at the right-hand side, the probability of the global growth being lower than our central forecast, this 2.9%, is higher, indicating that all the risks are in the downside. If we have a look on the advanced economies, almost all of the advanced economies in our forecast saw a downward revision, but the highest downward revision is in the US growth forecast, which is now down from 2.4% to 1.7 this year. We have also cut the forecast for 2026 by around 0.4 percentage point. Other economies has also faced down revisions, and what we see that they will be affected more next year than this year. And this is mainly due to the relative strong performance that we have seen in the first quarter, and due to the strong export growth to the US. In terms of the euro area specifically, we are expecting that it will recover this and the next year, partly thanks to the interest rate cuts and all the increase in defense spending that we have seen in the region. However, with tariffs in place, we have also revised the growth rate to 1%. All these revisions are not just to the US tariffs. In fact, if we just focus on the tariffs, the revision have been more substantial. So one thing that we have done is a scenario analysis, just focusing on tariffs. And here you see in this chart the results of that scenario. And we find out in this scenario that the US economy could remain about 2.5% lower by the end of the decade. So in the chart, you are seeing the GDP impact by 2030. And countries like Mexico, China, and Canada are all the major economies that are going to be hit hard when tariffs are in place. Euro area, as you can see, on the other hand, is only slightly affected thanks to the protection of being in the single market. In the chart, you can see two different types of bar charts. One includes no any of the oil price impact that we have seen. But if we include or we factor the 50% drop in oil prices, we can see the red chart, the red bar, that the negative effect of the tariffs are reduced slightly, mainly through lower inflationary impacts. If we focus on inflation, especially on the advanced economies, we think that tariffs will be a huge inflationary shocks to the US, which we expect to average 3.6% this year, as you can see in the chart. And this is 1.5 percentage point higher than our forecast 3 months ago in winter. We have also revised US inflation for the next year, 1 percentage point to 9.9 for the next year. On the opposite of the US, we have downward revised our inflation for the euro area to 2% for this year. And while we have reduced the forecast in Japan, we think that there are some inflationary pressures in Canada that are mainly through exchange rate. So that's why we have revised Canada inflation forecast upward. Overall, as you can see in the figure 2, the fun chart, we expect that OECD inflation to fall 2.7 this year and 2.2 next year. So that's our main case forecast. That this excludes Turkey, that has exceptionally high inflation. And as you can see, the risks are on the upside due to the possible escalation of tariffs war and the retaliation of other economies that could happen in the next months. In terms of the monetary policy and fiscal policy, despite all of these inflationary effects of tariffs, we think that the Fed will continue to cut policy rates twice this year to 4% by the end of the year. We expect that the ECB to continue more dovish with 2 more cuts on top of the 3 cuts that we have already seen this year. And elsewhere in the Japan's, for example, central bank, we expect to continue gradually raising the rates, while we don't expect any changes in the China main policy tool. On the fiscal policy front, here you have the figure of the budget deficit GDP ratio. We expect that the continuation of these large deficits, despite of the high level of public debt and high debt service cost. This is mainly due to the new fiscal packages that we've seen have taken place in the European Union, particularly in Germany, that will allow up to 1 trillion of additional public spending for the next decade. In terms of this German package, we have written a special box just on the macroeconomics impact of the package in Germany, which we find that there is an initial negative effect on Germany and EU, mainly due to their rise in the risk premium, but over the medium term, we see about a 0.5% positive GDP effect on Germany. You can get more insights on the box in the outlook. And finally, I just leave you there with some of the numbers that I mentioned, and those are our main forecast numbers. And I will hand over to Fergus for the UK outlook.
Thank you very much, Patricia, for an excellent presentation on the global economy. Good morning, everyone. I'll be discussing our latest forecast for the UK economy. As usual, the UK outlook was a team effort, and I'm grateful to my colleagues listed on the screen for their hard work on this. So to give some background to the forecast for this spring, we put together our UK forecast at a time of immense uncertainty from both domestic and global factors. Recent headlines have placed emphasis on the effect of trade policies from the United States on the world economy, including the UK economy. However, we think that domestic factors are the centre of the story, particularly for this year. In April, we saw the Chancellor deliver the spring statement, which restored razor-thin headroom, but did not put the public finances on a fundamentally more sustainable footing. Hikes in the national living wage and employer NICS contributions also came into effect in April. And so tariffs have added an additional layer of uncertainty, but we think that their direct impact on the UK on aggregate will be limited. That being said, there are regional differences in exposure to tariffs, and more on the regional impact and the effect of yesterday's trade deal with the United States will be covered in the regional outlook presentation following this one. So with that background, the key messages from our forecast are as follows. We have downgraded our GDP growth forecast for the year to 1.2%, which is a 0.3 percentage point downgrade on our February forecast. And we think that there is reason to downgrade due to persistently weak sentiments among households and businesses this year, and an uncertain financial outlook for businesses amid rising cost pressures and tariff uncertainty. We think that inflation will be above target this year at 3.3%, owing to regulated price increases and pass-through from strong wage growth and employer NICs. Regarding the bank rate, we think that there will be 2 further basis point cuts this year, with 1 further cut early next year. It should be said that one of the basis point cuts for this year happened yesterday, which we correctly anticipated. And finally, we do not think the government is on track to meet its fiscal rules. So moving to GDP growth, we think that growth this year will be driven by government spending, as the £70 billion a year stimulus over the next 5 years announced in last year's autumn budget comes into effect. We have downwardly revised business investment this year, owing to persistently weak confidence. And so from next year, we expect business investment to pick up again, and from there on contribute positively to GDP growth over the remaining forecast horizon. Before we discuss the risks to our forecast, I think it's worth quickly explaining the fan chart. The fans illustrate uncertainty based on previous forecast errors and are wide in this outlook due to heightened uncertainty at the moment. There's no skew in this fan chart, as we are of the opinion that known risks are better described through scenario analysis. That being said, we judge the risks to GDP growth this year to be broadly balanced. On the upside, significant fiscal loosening over the forecast could have a higher than expected multiplier effect on GDP. Evidence of underutilization within businesses from, for example, the Confederation of British Industry suggests that there is scope for government spending to have a greater positive impact on growth than reflected in our central forecast. However, on the downside, there are signs of labour market tightness in strong wage growth, elevated quits, and still elevated vacancies, which may limit the extent to which government spending can foster growth as opposed to stoke inflation. We judge the risk posed by second-round tariff effects to also be balanced. On the upside, trade diversion could see an influx of cheaper intermediate and final goods enter the UK market, which could spur demand and production. But on the downside, we see further tariff volatility could potentially weigh on economic activity over the forecast, and depressed growth in the global economy could reduce demand for UK exports beyond that which is captured in our central forecast. Moving on to CPI inflation, we think that inflation will average at 3.3% this year, rising to a peak of 3.7% in the third quarter. We see inflationary pressure this year coming from regulated price increases, but also pass-through from increased labour costs in strong wage growth and employer NICs. I would encourage everyone listening to actually check out our UK Outlook box on the effect of the rise in employer NICs, which will in much more detail delineate the effect of this policy on inflation and growth and employment in the UK. We think that inflation will return to target from mid-2027. And domestically, we judge that there is upside risk to inflation coming from persistent wage growth due to ongoing labour market tightness and elevated inflation expectations. On the downside, weak sentiments may weigh on aggregate demand for longer than expected and thereby reduce inflationary pressure. Globally, we see both upside and downside risks to inflation. We think that supply chain disruptions from tariffs and risk of sterling depreciation pose upside risks to inflation. However, trade diversion, lower oil prices, and dampened global demand pose downside risks. So moving to monetary policy, at the time of the forecast, we anticipated 2 more 25 basis point rate cuts this year and 1 next year. The first of this year's 2 additional cuts happened yesterday, which we correctly anticipated. We think that the scope for further cuts beyond that which is captured in our central forecast is limited, meaning that we expect fewer rate cuts than the market. The reason for our judgment on this is that domestically we are seeing persistent inflation, elevated inflation expectations, and strong wage growth. And globally, tariffs contribute to trade and financial fragmentation, which increases the costs associated with international transactions. Things like supply chain disruption, we think may add to inflationary pressures for the UK. And so we think that the Bank of England, in their gradual and careful approach, which they maintained yesterday, will not be too eager to give any jumbo rate cuts in the foreseeable future. Moving on to the labour market, we expect unemployment to rise this year, reaching 4.5% before falling towards the end of the forecast period. We think that upward pressure on unemployment comes from hikes in the national living wage and employer NICs. However, much of this upward pressure on unemployment will be mediated by labour demand from public sector activity, which may also reinstill some confidence in businesses. In line with that, we think that there will be strong wage growth of 5.1% this year, owing to still persistent labour market tightness and elevated inflation expectations. And we expect wage growth of around 4% over the remaining forecast period. We think that our unemployment rate forecast is consistent with continued labour market tightness, as we judge the unemployment rate over the forecast to be either at or below its natural rate. When we pair this with compressed wage differentials as a result of kind of consistent hikes in the national living wage above inflation, with inflation expectations being elevated currently, we think that there is scope for continued strength in wage growth as pay differentials become re-established and the labour market remains tight over the forecast. Moving on to fiscal policy, we do not think that the government is currently on track to meet its first fiscal rule, the quote-unquote stability rule. This rule states that by the final year of the forecast, the current budget deficit should be brought into balance. We have revised our cumulative growth forecast downwards since February, and with that, we have revised our tax receipts downwards. And this leaves a £57 billion shortfall in fiscal headroom, which is equivalent to roughly 1.6% of GDP. It's worth putting this number into context. To quote a colleague of mine, a £57 billion shortfall in headroom is not so much big as the 9.9 billion buffer is small. We think that the 9.9 billion headroom that was renewed in the spring statement is simply not a large enough buffer against cyclical shocks. Furthermore, merely a month after the OBR forecasted government borrowing in March, annual borrowing was revealed to have overshot by 15 billion. So we think that a couple months here and there of higher than expected borrowing or lower than expected growth will get you to a shortfall of 57 billion in 5 years fairly comfortably. And it's also worth noting that the OBR's average forecast error for the current budget deficit is 1.3% of GDP, which is pretty close to our 1.6% shortfall forecast. We also think that the government is not on track to meet its second fiscal rule, the investment rule, which states that public sector net financial liabilities should be falling in the final year of the forecast. We think that it will rise from 88.8% to 89.5% of GDP in the final year, thereby violating this rule. I think that the takeaway from these fiscal numbers are that in the spring statement, the government seemed insistent on maintaining their ironclad and non-negotiable fiscal rules. This anticipates a pretty difficult autumn budget, given our forecast that they're not due to meet them by autumn at present. And the difficulty in the autumn budget will manifest in a decision for the government, which is to either hike taxes and or cut spending. Again, this is all because the government seems to be insistent on playing this fiscal cat and mouse with these fiscal rules. And we think that this tees up a difficult autumn budget later on this year. So to recap on our key messages, we expect GDP growth of 1.2%, driven by government spending. The downgrade from our last forecast reflects dampening effects of persistently weak confidence, business cost pressures, and tariff uncertainty. We think that inflation will be above target this year at 3.3%, but return to target from mid-2027. We forecast only 2 additional basis point cuts, 25 basis point cuts from the bank this year, owing to loose fiscal policy, strong wage growth, elevated inflation expectations, and global trade uncertainty. And we think that the government is not on track to meet its fiscal rules, anticipating a difficult autumn budget.
Thank you very much, Fergus. Thank you, Patricia and Stephen. Good morning. I'm delighted to present our outlook for UK households, devolved nations, and the English regions, which is joint work with my colleagues named on the slide, and my huge thanks to them for their hard work. Our outlook is really the result of trying to understand how the global and the national economy affect different parts of the country, different sectors, and indeed households. And our key messages are as follows. Whilst living standards are not declining across the board, they're sort of flatlining this year, we are seeing pressures on the poorest households. And that is really to do with the fact that they consume more of essentials, and the price of essentials, is in the case of food, for instance, going up. And so there are distributional implications that we have to understand here, and they're very important for the poorest 30%. Secondly, we also see that there's regional and sectoral exposure to US tariffs. And as we've already heard from both Patricia and Fergus, there's a lot of uncertainty over tariffs, often daily changes. We've had the announcement of the US-UK deal yesterday. In aggregate terms, it doesn't really affect growth very much, but there are sectoral and regional implications. And so we've done some work just to show where there is exposure. And it's really to do with certain industries in particular parts of the country, notably Wales, the West Midlands, and parts of the North. And then finally, we've done a bit of work on housing access and affordability. And again, there's some stark regional variations that are not always revealed by more aggregate measures. So let me first turn to our analysis of living standards. So last year was a really good year because real personal disposable income grew by 4.1% in the financial year 24-25. And that was, of course, welcome after 2 years of the cost of living crisis. But even then, we already found that some of the poorest households had not returned to the pre-2022 levels. So again, there are distributional differences here that are masked by just the aggregate number. Now, for the financial year 25-26, we're projecting just 0.1% of growth in real personal disposable income. So really a situation where it's flatlining. And flatlining means that for certain parts of the income distribution, things are really very, very difficult. There are significant differences between low-income households compared with middle or high-income households. And for this financial year that has just started, we're saying that households in the bottom 30% will face some severe pressures. And the way that this is really best illustrated is as follows. In terms of disposable income, we're seeing a hit to the poorest 30%, in particular the poorest 10%, whilst for the rest of the distribution, the picture is rather better. Now, why does this matter? It matters for two reasons. One is we have to understand these pressures, that disposable income for the poorest 30% is going down because they are seeing a greater proportion of their household budget spent on essentials. And for instance, the essentials such as food are, rising faster than average inflation. So even if your benefits are rated in line with inflation, you end up being worse off. Whereas for the rest of the distribution, there's going to be some improvement. It's not significantly, high, and certainly lower than last year, but there is some improvement here. And really, what's interesting compared with the cost of living crisis is that the so-called squeezed middle, so the income distribution or the deciles 2 to 4 are not seeing the same sort of hit that they experienced in 2022 and 23. So there's some good news there for middle income households, but not at all for the bottom 30%. And then we have to think about policy that might make a difference, such as, for instance, an uplift in universal credit. Moving on to our regional analysis, again, in aggregate terms, the tariffs won't affect UK growth, but there are some significant differences in both regional and sectoral exposure to US tariffs, whether they're 25% or 10%. So let's look at some of the detail. And what we can see, first of all, is that when you just look at the proportion of goods exported to the United States in relation to total exports, then you can see here that there are some areas that stand out. The West Midlands in particular are exporting, somewhere near 25% of their total exports to the United States. So that's quite a bit more than in other parts, though in the east of England, there's also some exposure here. And really what this is to do is with the location of certain sectors such as the car industry, aerospace, but also aluminium and steel. So that's one way to look at it. But of course, that doesn't yet tell us how important it is in terms of economic output. So we've done a little bit of work also on that. Now here you can see that really the exposure in total terms is not very big, which is why the aggregate economy won't be affected. You can see that, for instance, for the West Midlands, it's 25%, but that only amounts to about 4% of output as measured by gross value added. Now in Wales, it's a bit more than 4%, or it was more than 4% in 2022. Now it's sort of 3.5%, because there is, the steel production at Port Talbot, and that is going to be affected, as well as some of the aerospace that is located in Wales. Nevertheless, if tariffs were to hit, maybe be raised again, or even at 10%, we're expecting some sectoral impact for certain industries, such as car, aerospace, steel, and aluminium, as already mentioned. And it's really also that a lot of these things are interconnected, so that when you have steel and aluminium, that will feed into things that depend on metals and products. But it's really the car industry, including aerospace, that are the single biggest sectors affected. So the good news of the deal yesterday, insofar as we can tell, insofar as we have the detail, is that now the car industry and aerospace will be less affected when those tariffs are only 10% instead of 25%. So in sectoral terms, that should be rather better news than what we had on Liberation Day a month ago or so. Now we're going to move on to housing, which is the final part of our analysis. And really housing, as we know, is one of the top priorities of this government, with an ambition of building 1.5 million houses in the course of this parliament. And it's really, really important to understand, where these houses should be built, and also what type of housing is required. Now, if we just look at it in very broad regional terms, if we just look at the 12 regions, which is ITL1, then it doesn't really tell you about the needs. Whereas if you break it down, as we have done in this analysis, you can see that below the very aggregate level of just 12 regions, there are some significant differences. So, for instance, within London, we find that, whether it's credit access or, just housing prices, of course, London is below the UK average for housing access, means that there's some real need, and it's also tough for people to get mortgages, given that prices are high and wages are not necessarily enabling people to get onto the housing ladder. Similarly, for the south and the east of England, there are some sub-regions where first-time buyers face above average barriers. So really what all of this emphasizes the local nature and complexity of the housing market. There's some huge variations not captured by more aggregate measures, be they national or be they at the level of the 12 ITL1 regions. Now, it's not all bad news. In some of the regions in the East and the West Midlands, housing is more accessible relative to the UK average, which is very welcome, because there's a more favorable alignment there of incomes, prices, and mortgage availability. But this sort of analysis is really important as the government thinks about setting housing targets for particular parts of the country. And what we're really saying is that local needs and sub regional needs really have to be taken very strongly into account if that 1.5 million housing target overall is going to work for the different parts of the country. So let me just conclude with some brief thoughts. The government has acknowledged in its English devolution white paper published last December that the UK has more regional inequality, slower wage growth, and a relative decline in living standards compared to other developed economies. So that's an important diagnosis, an important recognition of where we are. What we therefore need in order to tackle these problems is a comprehensive, credible plan. We need to boost both national growth, as Fergus has already indicated, but also regional growth, because otherwise there's a drag on the national economy. And we have said consistently that this needs to be done through well-tailored, targeted public investment projects that help unlock greater business investment, and not just in the already productive and prosperous parts of the country, such as London and the Southeast, but also in the other parts. That is really, really important to rebalance the UK economy. And in terms of targeted policies, we would urge the government to consider looking at a universal credit uplift to help the poorest 10% through this difficult year in terms of living standards, but also to look at R&D support in the regions and export finance for SMEs to shield them from that higher tariff uncertainty that we have identified. Thank you all very much.
And thank you, Adrian, Patricia, and Fergus, for some excellent presentations there. Neil has just put into the chat that we're going to shortly turn to questions. So if you have anything you wish to ask, please do use the chat function. I'm going to reiterate that. We have one question. If we don't have many more, then basically I'm going to have to make up questions and annoy the presenters. We really don't want that to happen. So if you can put your questions in the chat, that would be good. I'm gonna start out by reading a question from our former director, Jagjit Chadha, who says, "Excellent presentations, thank you. Given wage pressure, but also the fiscal boost on your forecast of several percentage points of GDP, I would have expected a much more hawkish path for bank rate over the forecast horizon. Why are we hugging the market path so closely? And the corollary of that is that there should be skewed inflation risk to the upside. So, Fergus, are we not hawkish enough?"
Well, it should be said from the get-go that what we do is forecast what we think the bank will do, not what we think they should do. So, whether or not our judgment on the hawkishness of their path is consistent with inflation stability is a slightly different question. So we think that the bank will make these cuts. Whether or not we think that is appropriately hawkish or not is slightly separate. Certainly in our central forecast, we have reflected that it is not consistent with target inflation over at least the short to medium run. A slightly unsatisfying answer maybe to the inflation risk skew is that with immense uncertainty from global risks, it's quite difficult to put a good gauge on the skew inflation risk. But that being said, in our central forecast, we have more inflation persistence than the bank's latest forecast. This perhaps slightly dovish path, by your judgment, does materialize in higher inflation in our central forecast. Beyond that, I would say the risks are what they are.
Thank you, Fergus. We have a question from Mina. Just saw your surname a second ago. It's gone again. But Mina, if you'd like to unmute yourself and ask your question.
Hello, can you hear me?
We can indeed. Go ahead.
Yes, I've been following the government's industrial policy discussion, which I believe is going to be revealed sometime next month. And I wondered whether you feel that there's any macroeconomic implications that are likely to follow from something like this, either generally to the economy or maybe more importantly regionally, as it's likely to have certain sectoral priorities.
Adrian, one for you, I think.
Yes, I think the answer is that we don't really expect it to affect aggregate growth, certainly not over the next year or so, as nothing very, very ambitious and bold has so far been discussed or trailed. But it is true that the industrial strategy that we're expecting at the same time as the spending review on the 11th of June will have some regional implications, because we're going to get a better sense of what the government is planning in terms of some of the public investment in the regions, but also how it's trying to ramp up business investment in other parts of the country, like London and the metropolitan parts of the southeast. So we've already had some announcements in the spring statement and before that in the autumn budget on certain public spending projects, including in the area of defense. And a lot of that is outside of London and the southeast, though not all. So it'd be very interesting to see whether defense spending and industrial policy linked to that will be set out in greater detail in that strategy, which could then have some implications for certain parts, which are also affected by this tariff uncertainty we have spoken about. So it could be that in parts of the East and West Midlands, we'll see more. It could be that we see it in parts of the North and indeed in Scotland as well, where there are important elements of the defense industry and also military bases. So yes, it will have some regional implications. I guess there are two questions here. How focused is it in terms of sectors? And secondly, what is the size of the investment that we might be able to gauge once we have more detail? You know, how much more business investment, hopefully leveraged by some more public investment, will we see? As always, we can only really have a better sense when we see that strategy, but it's very, very important that it has a strong regional dimension. Otherwise, the prospect for regional regeneration is even lower than it already is. We need to see that extra investment, that commitment, and a clear strategy from the government.
Yes, Adrian, the next question I have is from Peter Gordon. So Peter, would you like to unmute yourself and ask your question?
Hi. Yes, I've really got two questions. The speakers mentioned firstly was comments about the increase in the minimum wage. And we've heard for quite a while that people are worried about the minimum wage pricing people out, and it hasn't seemed to happen. At some stage it will happen. So I want to know what your view is on that, and when does the minimum wage, if you like, get too high? And moving on from this, there was a comment about the worst off households being affected most. I would have thought the increase in the minimum wage would actually alleviate that to some extent. Now, is that because the minimum households are poor off because generally they don't have a breadwinner who's working? Is that the issue, or is there something else at work?
Okay, so two questions there, the macro one and the micro one. This is the great thing about NISA is we can tackle both. So I'm going to ask Fergus to have a quick comment on the macro issue around the minimum wage, and then Adrian can tell us about the distributional implications. Fergus.
Thanks. Thanks for the question. Yeah, so there was a lot of speculation around rising costs for businesses and what that would mean for inflation and unemployment. As we've seen, there's been a limited effect on unemployment thus far. And I think you're right to point out when do these kind of hikes in the minimum wage bite. I would say that for us, the key risk of rising national living wages in recent years is that over the forecast we expect potentially a re-establishment of wage differentials, which will keep wage growth and therefore inflation elevated. I think the crux of this issue really is that your ability to bargain for those wage differentials depends on your bargaining power. We're in a situation with tight labor markets at the moment. Inflation expectations are elevated. Rising minimum wages could be more problematic at the moment than they typically otherwise might be, simply because workers have the ability to leverage their bargaining power to secure higher wages, which could impact inflation. Less clear how it would impact on unemployment.
Thanks, Fergus. Adrian, on the distributional side of things.
Yeah, thank you very much, Peter. Like the previous question on industrial strategy, really, really, really interesting. I think the first thing to say is that we welcome the increase in the national minimum wage and living wage, partly because of the shocks to lower income households since COVID and the cost of living crisis. So, you know, it's absolutely a good thing for people to earn more through work. And in the previous outlook published in February, we did show that actually there are some significant benefits, both in terms of income, but also labor market choices. But they affect mostly people in the second income decile. So therefore, not the bottom 10%, but the next one. And for them, it's really positive. They earn more, they can make the choice to work more or to go into work in the first place. And that is really, really important. For the bottom one, it doesn't have such a big effect, partly for the reasons you say, Peter, which is that not everyone in that income decile is in work. Or when people are in work, it's often very precarious, part-time work. So there isn't the same effect. And there's a greater reliance on benefits. Benefits are rated in line with inflation, but that inflation figure is from last September when it was lower than now. And so, there's still a real issue about how we help those bottom 10%. But on the whole, we're in favor of the national minimum wage and living wage going up, including above inflation rate, because low pay has been such a problem. And we have done work with the Low Pay Commission recommending these above inflation increases, and we're pleased that successive governments have taken that on board.
Thanks, Adrian. Well, we're in the remarkable position of having no questions at the moment. I did threaten to ask a couple of questions of my own, which I might do, but I'm kind of hoping that the audience has stuff to ask. I mean, it might just be a sign, of course, that all the presentations were so clear and our forecast is so sensible that everybody is just agreeing with us. But if you have
sorry, Stephen, I noticed that Jagjit had a follow-up from his earlier question.
Yeah. So I will come to that. But first I'm going to make the plea for people to have their questions. Okay, so Jagjit's follow-up is just querying that our bank rate forecast is consistent with the rest of our forecast, which I think it is. But Fergus, I don't know if you want to comment a little bit further on that.
Yeah, so I was just going to say that, since our last forecast, our bank rate path is very slightly more dovish, but that has been paired with higher inflation in the central forecast. We judge that the risks to inflation are broadly balanced, given that the additional rate cut that we now have, which we think the bank will do and has done, is consistent with higher realized inflation rather than higher inflation risk. So the risks are broadly balanced. And what's happened between our forecasts, which I think is consistent, is we've simply priced in more inflation in the central forecast, and that hasn't translated to risk.
Thank you, Fergus. We have a question. Hooray. Jeffrey Thomas. Jeff will ask it on Jeffrey's behalf. And it's for Fergus again. What are the implications of higher business costs? That's the minimum wage, national insurance contributions, etc., for business investment. And maybe I'll add the supplementary. Could you tell us about the impact of the general global uncertainty, particularly around tariffs, etc., on business investment?
Yeah, absolutely. That was a brilliant tee up, because I was actually about to say that there are two sides of this, right? There is a financial outlook that businesses are anticipating will make their lives maybe more difficult financially, but also there's the element of uncertainty, and businesses will only really invest when they're confident about their prospects. So to tackle the first half is that, yes, so higher business costs do look to be stifling business investment this year. We have downgraded our business investment forecast for this year, partly because of this. And this is reflected in survey data. The Deloitte survey of CFOs, you're seeing an uptick in defensive strategies among businesses, a reduction in expected capital expenditure. This is also consistent with the Bank of England's DMP survey. And these are all reflecting changes in business sentiments that happened even at the tail end of last year. I think the additional risk for this year is that tariff uncertainty and also still persistent domestic uncertainty will be weighing down business investment further. Potentially businesses are tempted to speculate over the potential for further rising business costs in the autumn budget. But of course, we don't want to speculate too heavily on that. I think at the moment, the headline barrier for business investment at the moment is the fact that they have squeezed margins. But in the periphery, and it's slowly coming to the forefront, is that businesses are just incredibly uncertain and they will put off investment until they become certain.
And maybe if I can just add one footnote, which is we talked about the minimum wage a minute ago when we had the question from Peter. And whilst we are in favor of minimum and living wage going up, it's precisely the NIC hike on employers that's made this so complicated, because then they're facing even greater cost pressures. Had it just been the rise in the minimum wage and living wage, I don't think we'd see the same problems with business investment. It's the NIC hike that I think we think on balance has been the much bigger impact, or had a much bigger impact. And of course, the two things together are really difficult, but that doesn't necessarily invalidate the importance of raising minimum living wage. So it's really the mix that is the problem here, and we already highlighted that at the time of the budget when that was announced last autumn.
Thank you. Okay, so I was about to say it's about high time we had a question for Patricia. So we do have one from RH. I'm sorry, I don't know your full name there. Audio is not working apparently. It's so I'm going to have to read it out. It's early days, but how do we see? Excuse me, sorry. It's early days, but how do we see the announcement yesterday changing the outlook, if at all? Are the UK better or worse off than before April? I think the answer is worse, but I'm going to hand over to Patricia to talk more generally about tariffs and uncertainty and stuff.
Yeah, thanks, Stephen. Thanks for the question. I mean, just as a month that we've been doing this forecast with all these announcements, it's been, as you can imagine, hectic with all the changes. Any favored conditions and any changes in the favored condition will impact in a positive way, but there's still a lot of tariffs, and as I was saying before, uncertainty around everything. So yeah, I mean, in the UK, as some of my colleagues were mentioning, in some of the areas, we'll get a better outcome from this deal, but if the tariffs are still imposed, and not just in the UK, also like in all the other trading partners, things will get worse for sure. And as I said, in our forecast, we only computed some of the tariffs in place on the 9th of April. We will have to see what happens when the 90 days pause comes to an end. But that's something that we'll talk about in 3 months' time, I guess.
Thanks, Patricia. I have another one here for you from Rianne. Rianne, do you want to unmute yourself and ask your question? Okay, you're on.
Yes,
Yeah.
I'm unmuted, I think.
Perfect.
I'd like to just try and ask if there is anything other than Trump we can talk about in the international economy. I do get this awful feeling that we are so focused on tariff policy that it's hard to think about anything else. So, Patricia, are there other things in the international economy that you're looking at? And particularly given that tariffs are mostly about manufacturing and services is a big other part of the economy, what else are you thinking about at the moment that isn't related to Donald Trump?
Yeah, that's a good question. Thanks for it. Well, I will say the second thing, it was the topic that we were talking before everything came up tariff, was the economic fragmentation of the global economy has been really influenced by all the geopolitical issues. I think that's already there. It's still there in the background of all this tariff. When we've been doing the forecast, we've been also talking about not just the manufacturing sector, but also like how the resilience of this service sector. We have been seeing all these challenges in the goods trade, but service sector continue to show this kind of like resilience in general. And I think other topics that we have to have in mind is how the banks, the central banks will react, how these monetary policy adjustments and how that will impact, for example, how the Bank of Japan compared to the Fed how that differentials on the monetary policy adjustment will have an impact on the economies in the coming months and years. And then, I mean, I think that as one of my topics that I'm really interested, no one now talk about it, but like climate and the transformation, the transition to net zero is something that we should be taking into account if we think about the long-term economic impacts. Is something that we have to take into account that now has gone from the focus of the economic debate. And also like digital transformation, I guess is going to be the other topic. But yeah, I mean, because I'm interested on this topic, I will say climate should be something that is there and it should be worrying us and is also impacting the economies. But yeah, yeah, good question. Yeah, I don't know if someone.
I would like to back that up. I mean, we should be talking about climate because actually, if anything, we're taking steps backwards in the move to net zero, moving away from net zero, really, is in terms of the world economy at the minute. So this is what people should be talking about. Absolutely. And judging from Rianne's comment in the chat that she agrees. So I think we're all in a very similar position there. I have a question from David Heald. David, if you'd like to unmute yourself and ask your question.
Thanks very much for the presentations. I was struck by the emphasis you put upon the employers' national insurance increases. What is NISA's view about the incidents? My understanding is that the OBR and the IFS consider that they will mostly fall on employees rather than on employers, though there could be a time horizon issue about that adjustment.
Great question, David. Fergus, do you want to have a crack at it?
Sure. You're right to point out the time horizon on the adjustment. I mean, what we've seen in the lead up, I should say, firstly, I agree. This is a classic case of the agent on whom the tax is levied is not necessarily the agent on whom it is incident. And you've got that with the NICs at the moment. What we saw in the first few months of this year was record high non-recruitment among firms. So firms seem to be scaling back hiring activity. And the time problem here is that obviously you're not going to get firms raising their prices preemptively because that would put them out of a competitive position. So it is of NISA's opinion that we might then be seeing from April a gradual pass through into inflation. But either way, if these costs are passed through onto unemployment, which we think is less likely to happen due to, as I said, labour market tightness and fiscal loosening, or if it's passed through to prices, employees in effect will pay for it. So yeah, it's a classic case where the incidence does fall on employees.
I think one thing we've emphasized that the OBR IFS much less, but I think is really important, is the effect on hiring. You know, the NICS increase acts as a direct disincentive to hiring. Now, if hiring goes down, you don't really notice that in the aggregate data quickly, but what happens is unemployment gradually rises as standard churn, if you like, people sort of losing their jobs. They can't then move into new ones, and that's when you see the unemployment rate rising. So we got that effect going on, although as Fergus says, there's a bunch of other stuff acting to bear down on unemployment. So we'll see what happens. I have one further question from Jeffrey Pugh, again, which is related, actually. So Jeffrey, should we try again to unmute you and ask your question?
Can you hear me now?
We can, brilliant.
Ah, good. Okay. Well, to be a little bit blunt, I wonder if you're kind of supporting contradictory things. On the one hand, you know, you want to alleviate poverty by increasing wages, particularly at the lower end. But on the other hand, you also presumably want increased business investment. Now, I mean, I very much appreciate the reply you gave earlier. You know, I can't see how we're going to get growth on a you know, at a higher rate without substantially increased business investment. Now, in a low growth economy, isn't there a trade-off? essentially we're going to have to consume less and invest more as a nation. Now, politically, that's probably unacceptable, but we're speaking as economists here. So my question is then, do we need to allow business margins to increase if we're going to have an increase in investment and therefore future growth? Thank you.
Well, I mean, there's a question in my head about what allowing margins to increase. I mean, if businesses want to increase their margins, they can just do it. And indeed, we have an element of that in our forecast. I think the more general point about if we
they can't increase margins in the face of a higher cost base.
I mean, you have firm set price, so they can always increase their margins. But I think the more important point is this: if we want to invest more, we have to save more. I mean, as a nation, we are woefully bad in terms of national savings. That comes from both the public and private sectors. We are going to have to reduce consumption, either by reducing consumption at household level, or by paying more in tax, which is another way of doing the same thing. Now, we've talked a lot over the past few years, and these are about the fiscal rules that are in place. And we noted again in spring that we had to effectively have a second budget as a result of the fiscal rules. Now, we don't need to do that. We can think of an alternative approach based on, okay, what do I actually need to achieve from fiscal policy and how do we do that? But if we don't do that, if we stick to the ironclad fiscal rules, then the result of our analysis is that we will have to see either further cuts in spending or increases in taxes, or a bit of both at the budget in October. All of that is almost besides the fact that we need to see more investment, both from the public sector and the private sector. So yeah, times are tough, really, I think at the minute, but it's not just for the UK. The global presentation of Patricia is illustrated that we think global growth is actually lower than average now at the minute. It's a tough old time. And that's not really the positive note on which I wish to end the presentation. So I'm going to try and be more positive by thanking those people who asked questions. I thought the questions were excellent. I thought the presentations were excellent. I thought this was a good example of the kind of discussion about the macroeconomic outlook and macroeconomic policy, and indeed the link down to household level well-being that marks NISA as the organization it is. And again, if you want to support our work, if you want us to continue doing this kind of work, then please consider becoming a member. The information is on the website. You will also be receiving a missive as a thank you for attending this webinar. And there'll be information about individual memberships on that too. But in the meantime, I'd like to thank everyone in the audience for coming. I'd like to thank, again, my excellent colleagues for their presentations. And I'd like to wish everyone a wonderful rest of the day. As I said, it's a beautiful spring day out there. So if you can try and get out and enjoy the sunshine, I know I won't be able to until this evening, but please do. And we'll see you all, hopefully virtually, in 3 months' time. Thanks, everyone. Bye-bye.